We are seeing near-term inflation. Inflation appears to be reasonably sticky. Every single day we're watching the next indicator that comes out. We'll watch today when the Federal Reserve produces its minutes, and we'll all read through with a fine-tooth comb to see what they say and if they're going to change and what indicators they're looking at. 3-month annualized inflation. There's such just a full sheet of different measures of inflation that we look at to try and divine whether it's truly coming down. People were buying, a year ago, they were buying onto the LA port system and paying $200 a year for just the visibility of how many ships are in port, because that was a measure of inflation. So yes, we're watching. Near-term inflation is elevated. There's a potential that's coming down. Where does it come down to? That's another question. But what does that do for us? What are the opportunities? Well, as inflation comes down, we'll see interest rates likely pause. That makes quality growth opportunities. Growth is growth-oriented assets. Those kind of companies that produce large amounts of cash flow well into the future, less so today. So think technology, think Tesla, when they're going to be flying cars around in the future and producing lots of cash flow well into the future. Less discounting on that cash flow produced in the future. It makes real assets attractive to buffer yourself from economic volatility and inflation volatility. Real assets are things that have a real tangible value that is likely things like real estate, energy, credit. I believe that yield buffer and the pricing is in a better place for you right now than I'd say just a pure valuation on equity markets. So it's an attractive place to be. It's an attractive time to lend to companies. As a portion of your portfolio, you should hold a piece of credit, of corporate bonds, because you earn a little bit of spread premium, you have that buffer, you have a higher yield, effectively, in your portfolio than you had in the past. As I say, before we were talking about, oh my gosh, well, you can lend to these companies at 4%, or this prospective high growth environment gave you 20% in the equity markets. I know where I put my money. Now I'm looking at a lower growth environment where it'd be nice to get 8 to 12% in the equity market. That's your proverbial long term. At the same time, I get 9% on a high yield bond that's got some security to it. The dynamic is changing a little bit. So it's an attractive time to hold credit. It's an attractive time to look at some of the distressed credit names that are out there. That's another thing that we do. Fundamental forces, we talked about the macro forces, what they lead to, fundamental forces. We've got bottom-up outlooks that are looking at elevated market valuations right now. We're looking at an earnings recession in the face. We just got the first quarter of it, and your recession, a technical recession, recall, is 2 quarters of negative growth. Whether that is real economic growth, GDP growth, or earnings growth, it's 2 quarters of negative growth. We're one in when we're done with this earnings cycle. So what are our bottom-up outlooks telling us? The opportunity is up in quality. Quality is a specific style. It's one that we specialize in. We think this is a good time for that. This said resilient margins. Inflation is a key issue here. I must have said it 40 times in this presentation. It erodes that amount of profit that you can make per unit of revenue when you have to pay your employees more, but you can't rise the price of goods. If demand destruction starts happening, that's a concern, and that's something that we're very clear on. So we look at what goods our companies that we hold are selling. We look at what pricing power they have with their consumer. We look at what power they have to manage their wage growth as well. So selection is key on the bottom-up outlooks, and that's one of the key metrics that we are looking at. Rate outlooks. Rates are telling us that we're range bound higher rates, but we are at higher rates. We don't expect to see rates coming down dramatically, but we expect to earn a significant yield for those rates because we're going to see persistent inflation. We think it's going to come down, but remain elevated. So, as I said, growth sensitive yield in corporate bonds is attractive. I'll go forward. There's a bit of a summary here. I won't belabor all this, but hopefully this is helpful for you in the end. Maybe just keying on a couple of things. The consumer is still buffered. The consumer built up an excess savings during COVID that was significant, over the average usual savings rate. People had more money in the bank. They were more careful. They stopped spending in certain areas that were usually a big detractor to their savings ability. We still have about 1.7 trillion of excess savings in the economy. That's a decent buffer for the consumer. That keeps us from having this forecast of a significant downturn, a retraction in economic activity, a heavy-handed recession, what they would call a hard landing. That's a good thing. Think about the central bank hiking cycle. That's something that we all are watching, but we also know it's a leading indicator of it. It says it has an elongated effect. It's not the Fed says we're going to hike by 25 basis points and automatically the economy adjusts. The economy adjusts over time to that. Recessions happen after those central bank hiking cycles. We'll be watching for when the Fed gives us that all clear indication that they're going to pause, they're going to stop, they're not doing that yet. That's going to come with inflation transparency first, so we're watching for that first. China's reopening. We know that's had an effect since about September, October of last year. Gosh, that was dramatic. I mean, China basically said they went from being, we're going to be a zero COVID policy. If you have COVID, we're going to put a guy outside your door and you're not going to leave your apartment, to we're just going to let it all go and see how the chips fall. If you don't like it, then we're going to let everything reopen. That's led to some pretty dramatic changes in the environment. I think they've had a better experience than, at least recently, than they've expected. We're going to see those impacts. We're going to see the impacts of material purchasing, of consumer purchasing, of a potential consumerization of the Chinese economy. That's going to lead to some growth in inflation as well. So that's about where we are. US dollar strength, we saw that all of last year. The US dollar was up relative to many currencies, or relative to a basket of currencies. This year, it's all dependent on, because currencies are a relative value instrument. They're always relative to every other currency out there. It's not a valuation in isolation. If we see the Fed pause, if we see inflation come down in the United States, it is more than likely that we see the US dollar drop a little bit. That will help earnings. That likely has an inflationary impact, but I don't think too much. But it's something where I think the elevated dollar right now is revealing some systematic concern. It's revealing a place where it's a safe haven if people are putting money into the US dollar as a safe haven of assets. I'll talk quickly about the more interesting things, I think, of investment thematics. So you hear about all these things. Well, where do I put my capital, bonds and equities? Which individual companies might I invest in, the styles, what are important? But you also invest for the long term, and you think about things that are important to you, themes that you think might lead to future growth, things that actually, when you look 10 years down the line, you go, man, I was the brilliant person, I got that, I knew what was happening. I just pulled together a quick list of some of the major thematics that are out there, investment themes that you might look at. You might invest in technology and innovation. Artificial intelligence is key on that. Cloud computing is still here, cybersecurity. All these things are investment themes for which we're looking for significant growth. We're going to see significant growth in many of these themes, and you want to pick the right horse. You want to find those companies that are able to manufacture good growth and cash flow out of that. Sustainable clean energy, of course, the misnamed Inflation Reduction Act just gave us a big signal that the government is behind this. They're going to put dollars at work, $400 billion over the next 30 years into building up clean energy technology, especially. Healthcare is an actual emerging thematic. There's a lot of changes that are happening in healthcare that are worthy of note and are worthy of thinking about having a thematic investment in your portfolio. Just healthcare technologies that allow things like the electronic, the digitalization of healthcare records, of using AI to help solve problems, to help diagnoses, to help doctors operate. All of those things are thematic. I find it kind of funny that, I put together the presentation that had the thematics in there, and I went to ChatGPT. I'll do a quick survey. Who's heard of ChatGPT? Who's actually used ChatGPT? ChatGPT, if you haven't used it, I'll tell you, it is amazing. It is very different from doing a Google search. A Google search, you put in your Google search of where might I stay when I go to the beach in Barbados. And it gives you a bunch of different links. Some of them are ad-supported links, and you're like, I'm going to scroll down to the ones that are hopefully more candid about what the answer might be. And then you have to pick, and you have to go through 50 different links. The artificial intelligence of ChatGPT, you say, where might I stay when I go to Barbados? it goes through that, and it gives you an answer based on what it thinks as a machine, effectively. Or if you're a 14-year-old and you want to write your term paper, yeah, you can imagine, I've got a 13-year-old, so I'm envisioning this already. I put into the ChatGPT engine, well, what investment thematics might I look at? It did a better job than I did at writing out the investment thematics. That's what it wrote. It was pretty amazing. So I kind of think about it of, we used to talk about AI and machine learning as a lot of service industry jobs and some lower level jobs might be at risk, or we can find efficiencies there, however you want to think about that dynamic. I'd say it's everyone that's at risk. It's this guy standing up on stage that's going, AI is solving investment problems, AI is solving medical problems, AI is providing efficiencies in places that we did not know it could really do before. So it was interesting. That was the output literally from my computer of ChatGPT. That's the interface that you look at. It will be transformational. It just came out, so you know, because if you haven't heard of it, if you haven't used it, it has long been talked about. You could already use the artificial intelligence. They just introduced this one from a company called OpenAI that Microsoft made an investment in, and it's brought it to the world in a way that we just had not seen it before. It's been there. It's got a ways to go. How do you play this thematic? Well, there's many ways you can do so. We look at things like the chip makers that support this kind of technology. NVIDIA, I put down as one of those. We look at individual opportunities that say, for looking at this thematic, what's going to be the best under-supported technology with chip makers? As I said, Microsoft, almost the minute that OpenAI released ChatGPT to the world, which really needs a better name because it is a mouthful. Microsoft put $10 billion into OpenAI or contributed to the project $10 billion. They are going to be using this for customer facilitation, for things like use in their Bing engine, to where you can go on and it's a search engine that's comparable to Google. They're going to attack that ad revenue. Finding those kind of opportunities will be important. Service companies, just general service companies. You think companies like Macy's, that you go on and it helps you find what you need based on characteristics of just talking to you. You think KFC in China already has AI that knows who you are, listens to you, looks at you, says what you might like, what time of day it is, what you might be hungry for, makes suggestions on the back of that. It's pretty amazing how they're being used. So look for companies that have those opportunities and are embracing those opportunities for that thematic. Sustainability, which is really, I put this down as clean energy, where we're looking at the thematic primarily. Well, we just saw the Inflation Reduction Act. That was a $400 billion stimulus bill, if you want to call it that. Ways to play that, you look at clean energy companies. Solar Edge is one of those that we look at and we like. Materials segment, you look at lithium. You look at other areas that are supporting EVs. That's Albemarle. It's worth mentioning all these things. Healthcare, I'll move forward. On healthcare, of course, mRNA vaccines were what helped us through the COVID crisis. That was Moderna. That was others, Pfizer, that came out with this. Moderna is really keyed in on those. So you look at things that are thematics that you can invest in. Wearable medical devices, that's an emerging thematic. You think about the documentation companies, DocuSign, others that are going to get involved in this. Retail healthcare, being able to walk into a CVS or an Amazon. Capturing those thematics are important. So if you're thinking in the weeds of individual names you might hold, by all means, we're happy to be a partner on that and talk to you about where you might get involved, but these are some ways you might do it. I'll kind of leave you there rather than talk you through. What we do is once a month, we put together a capital markets outlook that says this is what we believe, this is where we think the economy is at risk, or on the upside or the downside, this is what the potential outcomes are. It's a two-pager. On the second page, it gives you a little bit of an outlook. By all means, your advisor that's here would be happy to get that to you every month. And I'd be happy to talk to anybody that is interested in it. I won't go through all the numbers. It's something that honestly you should get on your email and request. It just keeps an open conversation. That's what I have for you today. And any questions?
And real quick, thank you, Adrian. Real quick, we do have in front of you all a survey, a questionnaire, and it is a game that we're bringing back. We want guesses from you all on where the S&P 500 is going to be at the end of the year, the price of gold, the 10-year. You'll see different things. There is a question about what is going to be the best performing stock from March 1st until the end of the year. So you can't cheat and see what is up the most so far this year. It has to be from March 1 through the end of the year. And if you get that one right, you win an interview with Westwood. I'll kick off our questions first. Adrian, you alluded to quite a bit the prediction of a possible recession. How deep do you think that could be, and how do you think the market would react?
Good question. If we see a recession, so as I said, we're already at a low growth paradigm. We're at 0.5% consensus growth for 2023, not that much higher for 2024. We don't anticipate seeing a sharp retraction in activity. The kind of recession that we saw very sharply in 2020, or the kind of recession really that we saw during the global financial crisis. Why don't we expect that? The global financial crisis is kind of key here. That's the 2008 era that continued forward. It really pulled out a lot of consumer leverage. As I said, we have better consumer balance sheets than we've had in the past. We've got that excess savings than we've had in the past. We've got more of a buffer for if we see a significant recession. We're going to see the unemployment rate rise. We're going to see people lose their jobs. We're going to see layoffs. We're going to see where we are now around a sub 4% unemployment rate go up to 4, 5, 6%. Consumers are in better shape to weather that. We'll see purchasing continue. Consumption is 70–75% of our economic growth. So that's an important metric to say, we've got a better economy to weather something that would otherwise be like what we would call a leverage unwind. We don't have a lot of the instruments, we don't have a lot of the consumer leverage that we had during periods where we saw a sharp retraction in activity and a spike in many of the indicators like the unemployment rate. And companies, honestly, are concerned of firing people because they know how hard it is to hire people back. So we've actually got a little bit of hoarding of labor. That hoarding of labor is one reason why we're looking at unemployment rates that remain inordinately low, even with lower economic activity, because hoarding of labor is what companies are doing as opposed to firing people. They're keeping people that they know they would have a hard time hiring back in anticipation of at least a continuation to a better time. So it's hard for me to see a sharp retraction in activity. What does that mean for markets? It means markets weather this better. It means that 20% down in the S&P 500 that we saw last year is more representative of what we're seeing this year. It means there is potential for growth this year. So as I said, I'm not a typhoid Mary. I'll tell you that lower economic growth is likely and coming. But at the same time, we've seen much of the pricing already happen for that. There is potential for the markets to appreciate this year, for multiples to rise, for the exuberance of the investor to look not just at today, but what happens going forward. The markets can appreciate in the face of even a recession, and history shows us that. History shows us that actually the S&P 500, it starts appreciating that we're going to see a recession about 6 months to 9 months before the recession. Well, we've seen that. And it starts appreciating as in going up, even during a recession. So I think that's what we likely see, is we see a lower retrenchment in economic activity, but we are going to see lower growth. The Fed has put the brakes on. I think markets are pretty much already priced for that. We're going to see volatility, both economic volatility and market volatility, and there's going to be an extraordinary opportunity coming in the short term.
Thank you, Adrian. I'm sure we have some questions in the audience. Does anybody have any questions? Yes, right here.
You talked about lower earnings as the shoe that you expect to drop. Do you think companies that already pay a dividend will incentivize us by raising that dividend?
Great.
It's a very good question. I think that unlikely. And the reason that I think that is unlikely is companies are reluctant to raise their dividend, to incentivize that, to buffer that, until they see more transparency in the economic environment. They are more likely to keep it stable and say, let's make sure we can weather our cash flow. Let's make sure what we have is going to allow us to get through a difficult economic period before we raise our dividend. So It's good to have those high dividend companies. It's good to have, when we look at income-oriented companies, that's certainly one thing we do. We look at that dividend coverage, how much excess cash flow they have to cover the dividend. It makes that more important as a selection metric to say, let's make sure that the companies we have are well able to cover their dividends, so when we experience a downturn in economic activity, they don't cut. Those will be the important ones. It's, you know, it's similar to what you say, which is I don't expect them to raise the dividend to offset what we see a downtrend in earnings. I expect it to be more attractive to hold those companies that have a higher dividend coverage, a higher quality.
Any other questions? I will. Yes, right here.
I was just going to ask Adrian, to what degree do you think the Fed's 2% inflation target will be delayed by deglobalization? If we have to reshore everything from China, does that delay that process materially?
That's a really good question. What I expect is that we are going to see, I'll just take it at a high level of, we're going to see sticky inflation, deglobalization, stuff that I talked about from China, the reopening of China, the onshoring of manufacturing that we are seeing and continuing to see in the United States. All of those things are inflationary. It's going to be hard to get the Fed to manufacture inflation down to 2%. That's the barrier for PCE. For PCE is at 4.4, 4.5% right now. To what extent? Tough. Tough, because for them to get down to 2%, a lot of people are going to have to lose their jobs. It's going to be a 7.5% unemployment rate, where by the time that we experience the economic volatility that comes down with the brake pushing that gets us to a 3% inflation rate, the pushback from the populace, the politicians, and everyone else are going to say, 3% is just perfectly fine, 2% is nothing but a theoretical measure. So I believe it's going to be pretty tough to get down to the 2% barrier. You're right that those are the catalysts. The 2% is going to be hard to get down to. I think we are seeing a sticky inflation metric that is going to remain elevated, but that doesn't mean that the Fed, that we're so concerned that because it's sticky, the Fed is going to push harder and harder to 2%. 2% is just a theoretical measure. 3%, it's fine as long as companies are still able to deploy capital for positive NDP projects, to still make money, and to still have an anchoring effect on their inflation, to be able to understand that we're not going to see, because it's at 3%, we're going to see stable inflation. Stable at 3%, if we're at 4.5%, 5% unemployment rate, my guess is that that's the new normal.
Wes, did you have a question?
Adrian, just kind of a long-term macro question. So from the fall of the Berlin Wall, so COVID, with the exception of, economic contractions, free trade and free market economics just, were up and to the right, essentially, for that entire period of time. Have we hit an inflection point with what's going on with sanctions in Russia and the China tension, or in your opinion, or is this just a hiccup that will resume the path we've had for the last 30+ years?
I'd say TBD, and TBD is in, yes, we saw a little bit of an inflection point, or at least a hiccup here. We were already seeing a manufacturing renaissance in the United States, more onshoring of manufacturing in the United States, more deglobalization. We're already seeing that, and then now we just got a signal that actually it may be safer to hold on to some of that manufacturing, not just because of what happens with the supply chain breakage like we saw during COVID, but also because of all the geopolitical risk and what that might mean for the food supply chain, for the lithium supply chain, for the chip supply chain, all these things that are really important to the underpinnings of the economy. So yes, we are seeing that, and I describe that as synonymous somewhat with the consumer. The consumer is a changed consumer. And we really don't have a good handle on that yet. We're trying to figure out all these new thematics are new thematics that are rapidly changing because of what we've seen during COVID. Microsoft Teams, as Westwood, we didn't use that much before COVID. We were conversing in the office constantly. We were conversing with one another. That's good, but it's not always the most efficient manner. We've adapted to that. We've adapted to Uber Eats. I never used Uber Eats to order my food before COVID. These are new consumerization things that are changing the behavior of the economy. I think somewhat that deglobalization, that changing of that it's TBD whether that's sticky. I think a lot of it will be. I think we'll be less globalized as an economy. We're gonna see that manufacturing renaissance in the United States. that's a good long-term growth to your question for United States relative to other countries. The consumer is another question altogether, but that's synonymous in this, and we're seeing change there.
I think it's interesting, pre-COVID, when Microsoft was launching Teams, their projection of where they would be in 2 years, they met in 1 quarter after COVID happened. I mean, just the amount of spending on technology has just been phenomenal over the last few years.
Yeah.
I think there was one other question over here.
Yeah, yesterday I saw Robert Kaplan speak at the Expect dinner. He made a very interesting point. He says we're so focused on nominal GDP, and I mean we're so focused on real GDP. And nominal GDP is through the roof and could stay there even during a recession. And the average person looks at their paycheck, looks at same-store sales, looks at revenues, they don't look at real GDP. And his comment was this might be a very strange recession that may actually seem good. You know, so if you're not at subsistence level worried about your eggs and your fuel, for everybody else it's going to look like money's flying and they're not, even though the headlines are going to say recession, recession. Any thoughts on that thinking, comment? It's an interesting thought. You go to North Park right now, it seems like the world's on fire.
Yeah.
Because nominal GDP, I think he said, was up 12% last year. It's phenomenal. And that's what you